Hello everyone, this is Alexander Nikolov. Let's take a look at the US stock market. As you know, the stock market has been in a serious decline since the beginning of May, and that's pretty much in line with my previous expectations. To recap, remember, I was looking for a third phase up here from last October's low. Actually, I think the last segment of the corrective advance that started in March 2009 actually started in December last year, and the first part of it is actually over right now with the decline that we've seen since the end of April. We have a strong confirmation that actually that's the case. The first leg up, or probably even the entire move up from the December low, is over. So staying at this larger term time frame, the weekly chart, again, the most likely scenario is to see some kind of a serious pullback here, followed by one final rally toward the 1400 level, and then 1 or 2 or 3 years decline back toward 900 or even lower. So the weekly chart is quite bearish already. Why? Because I believe that we have either seen the top of the entire corrective advance from the March 2009 low, or we may have one final top, but one final move higher with a slightly new high, slightly new top, but pretty much we are over. So let's go back to the daily chart. Right now the daily chart is in a downtrend. As you can see, prices are well below the 21-day and 100-day moving average, and the 100-day moving average has also started to move lower. And in this case, since the move up started in December, we can see the minimum requirement is the 61.8% Fibonacci retracement, which is 1284 level, but that's the minimum requirement. Much lower prices are likely. I believe that we'll see weakness toward 1257 at least in the next couple of months. Time-wise, the decline that started in early May will likely last at least in June and July, and of course we'll have 2 or 3 sharp intervening rallies along the way down, and then we may see one final move higher toward 1378 or 400 or even 1450 level, but that will be all of the entire bull market that started in March 2009. So overall the picture is quite bearish. The same message is telling the Nasdaq chart. Again, from the December low, we had a complete move up with the top in early April, late March, early April, and then secondary top, non-confirmation, a lower top just below the 2762 level, Fibonacci level, in the first day of May, and since then it was all it has been all down. The minimum requirement here is to see 2460 level, but most likely I think we'll see weakness toward 2322 level in the next couple of months or so. 2 other charts that I'd like to show to you. The first one is the stock market, the stock index, the SPY, S&P 500 index, divided by the treasury bonds. So this is the SPY ETF divided to TLT ETF, and as you can see with the last week's, this is weekly chart with the price action in May. Right now we are again in a bearish mode here, which means investors definitely prefer bonds over equities, and that's negative for the stock market. And the final chart that I'd like to pay attention to you is the volatility index, the VIX. The volatility was moving down, the VIX index was moving down, and the volatility was quite low since the beginning of the year, actually. But as you can see, with the latest move lower in the stock markets, the volatility exploded finally in the last week. Volatility moved, the VIX index moved above the 21 level, and the Bollinger Bands, 20-day Bollinger Bands started to expand. So right now we are in a process, in a situation where the volatility is likely to increase in the next 2-3 months. All messages that I have, at least in my methodology, in my work, are pointing lower. Of course, some strong intervening rallies along the way are possible, and not only are possible, but quite likely. But the path of least resistance is lower for the summer of this year. So that's all for today. Thanks for listening, and I'll be talking to you again later.